Hi and welcome to Tax Update number 8. I'm your host Andy Rainford, Chartered Tax Advisor and Content Editor at Tax Essentials for Advisors. In this episode, we're covering the standout points from the new Finance Bill, a milestone announcement from HMRC about making tax digital, and an interesting case involving private residence relief. Let's get straight into the new draft legislation. Finance Bill 2025-26 was published on the 21st of July, and it contains some really important measures. First up is umbrella companies, or rather those that use them. As a reminder, an umbrella company acts as an employer for temporary workers. They are often used by agencies as using them shifts any admin work to the umbrella company, which is also responsible for operating PAYE. This means that the agency is simply invoiced by the umbrella company. The problem is that some of these companies are rogue and don't account for the PAYE and NI contributions to HMRC. They may also use aggressive tax avoidance schemes. From the 6th of April 2026, agencies using umbrella companies will be jointly and severally liable for any amounts due to HMRC that go unpaid. Additionally, the end user could be responsible if they engage with the umbrella company directly. As an example, let's say ACOM Limited uses an agency to supply workers, and the agency uses an umbrella company. If the umbrella company doesn't pay the tax and national insurance to HMRC, these can be recovered from the agency, but not from ACOM. If ACOM contracts with the umbrella company directly, it can be pursued for the unpaid amounts. Another key measure is, of course, the changes to business and agricultural property relief. It appears that the backlash against the restriction of these reliefs to just £1 million have been ignored. This means that from April next year, inheritance tax will be levied on business and agricultural property when the transfer of value exceeds £1 million. The tax will be charged at an effective rate of 20%. The only change to the original published note is that the allowance will be index-linked from 2029. However, I'm sceptical about this, as that coincides with the date the nil rate band is supposed to be unfrozen. I'm really disappointed that the allowance hasn't been increased to a higher level. Despite the government trying to play down the number of affected people, it feels like a rushed policy that could have been better targeted at those using these assets as tax shelters. I am a little biased. I live in a rural farming community and have friends who will be affected. I know how much they are already struggling to remain profitable. And of course, while the focus has been on farmers, this will affect family companies too. This coincides with an article I read. There has been a reported uplift in the number of farmers looking to use the exemption for heritage assets as an alternative relief. This relief is often associated with assets of historical, artistic, or scientific interest, but can also apply to land of outstanding natural beauty. If you watch a farming programme featuring a certain former BBC presenter, you may remember the local council refusing permission for a restaurant due to a perceived threat to the status as an area of outstanding natural beauty. I wonder if in the distant future we might see the episode quoted as evidence in a tribunal case. Okay, on to everybody's favourite government department. HMRC published its fancy-sounding transformation roadmap. This is essentially a document setting out what it is planning to do to improve its service offering. It focuses heavily on digital services. Perhaps the most noteworthy thing that immediately jumps out is that making tax digital for corporation tax has been abandoned. Corporation tax is simply too complicated. To be honest, I'm not surprised, as most large companies are reporting digitally anyway. However, given that 40% of the tax gap is due to corporation tax, you have to ask whether the MTD project is going to end up being a vanity project, a fiscal HS2 if you will. In other news, there is sadly no fix yet for the Class 2 national insurance problem we reported on a couple of weeks ago. Taxpayers are still receiving SA 302 forms with amounts incorrectly showing as due. There is no need to pay this if you haven't already done so. A fix is expected in September, well ahead of the payment deadline next January. If you have paid the amount, it will become available to reclaim in due course. Just one case this week, but it's a win for a taxpayer. Mr. Campbell bought and sold 4 properties in a 5-year period. He claimed private residence relief on all of them. The revenue decided this was a trading activity and that he was buying and selling the properties as stock. Alternatively, it said that he never intended to make any of them his permanent home, so the relief wouldn't apply. This is where it gets interesting. Mr. Campbell was employed by his mother as a full-time carer for his father. He had in fact purchased each property with the view to living in them, but none turned out to be suitable given his father's needs, so he ended up living with his parents. This was enough to convince the First-tier Tribunal at the second time of asking that he was prevented from living in the properties by reason of employment. A nice reminder that intent is crucial in private residence relief cases, and what happens when circumstances change later on is often moot. Well done, Mr. Campbell. That wraps it up for this week. Thanks so much for watching. By the way, if you missed our recent webinar on the new rules for non-domiciled individuals, you should head over to our YouTube channel, where you'll also see all the tax and employment essentials update videos. Until next time, from me, Andy Rainford, bye for now.